Understanding tax evasion and tax avoidance, key differences and implications. Tax evasion. Tax evasion is the illegal act of deliberately avoiding paying taxes that are legally due. This typically involves actions such as falsifying records, underreporting income, claiming false deductions, or hiding money in unreported accounts. Tax evasion is a criminal offense and can lead to severe consequences, including fines, penalties, and imprisonment. Examples of tax evasion. 1. Underreporting income. An individual or business might report only a portion of their actual income to lower their taxable income. For instance, a contractor being paid in cash may not report those earnings to tax authorities. 2. Claiming false deductions. Falsifying expenses to inflate deductions, such as claiming personal expenses as business expenses. 3. Using offshore accounts illegally. Hiding money in foreign bank accounts to evade taxes, without declaring those funds or adhering to reporting requirements. 4. Payroll tax fraud. A business might underpay payroll taxes or pay employees off the books. Tax evasion is universally regarded as unethical and illegal. It deprives governments of essential revenue needed to fund infrastructure, education, healthcare, and other public services. Tax avoidance. Tax avoidance, in contrast, is the legal practice of arranging financial affairs to minimize tax liability within the boundaries of the law. Individuals and corporations use expert advisors to guide them in utilizing legitimate tax-saving strategies, deductions, and incentives provided by the tax system. While tax avoidance is legal, it is often viewed as a controversial practice, especially when wealthy individuals or corporations exploit loopholes to significantly reduce their tax bills. This can lead to reduced government revenue and public criticism, as it may be perceived as unfair to taxpayers who cannot access similar strategies. Examples of tax avoidance. 1. Using tax deductions. A business might take advantage of tax deductions for research and development, employee benefits, or charitable donations. 2. Setting up a legal entity in a low-tax jurisdiction. Some multinational corporations base their operations in countries with lower tax rates, a practice known as profit shifting. For example, companies have used Ireland's low corporate tax rates to reduce their global tax burden. 3. Tax-deferred investments. Individuals might invest in tax-advantaged retirement accounts like 401ks in the U.S. to defer paying taxes on their income until retirement. 4. Income splitting. High-earning individuals might legally transfer income to a spouse or family member in a lower tax bracket to reduce overall tax liability. The impact of tax avoidance on countries. Although tax avoidance is legal, it can have significant consequences for a country's economy and public services. When large corporations or wealthy individuals reduce their tax obligations, the government collects less revenue. This shortfall may lead to underfunded public services, higher taxes for middle and lower income citizens, or increased national debt. Examples of detrimental effects. 1. Corporate tax avoidance. Multinational corporations using profit-shifting strategies can reduce tax revenue in their home country, leaving smaller businesses and individuals to bear a disproportionate share of the tax burden. 2. Economic inequality. Tax avoidance may exacerbate income inequality by allowing wealthier individuals to retain more of their income, while lower-income earners have fewer options to reduce their taxes. 3. Reduced public services. Fewer tax revenues may result in cuts to critical services like healthcare, education, and infrastructure, ultimately affecting the quality of life for citizens. Conclusion. Tax evasion is illegal and universally condemned, while tax avoidance is legal but often debated for its ethical implications. Individuals and businesses using tax avoidance strategies are typically advised by experts who help them navigate the tax system within the bounds of the law. However, the potential loss of revenue due to tax avoidance can pose challenges for governments, as it affects their ability to fund essential services. Ultimately, policymakers must strike a balance by ensuring tax systems are fair, closing loopholes that enable aggressive tax avoidance, and holding accountable those who engage in tax evasion. Taxpayers, in turn, are encouraged to act responsibly, recognizing that their contributions are vital to the development and well-being of their communities. How companies and wealthy individuals exploit tax loopholes across jurisdictions. Tax loopholes arise when gaps, ambiguities, or favorable provisions in a country's tax laws allow individuals or companies to minimize their tax liability. These strategies, though legal, and result in significant revenue losses for governments. In the Caribbean, known for its mix of high-tax jurisdictions and tax havens, companies and wealthy individuals have utilized various schemes to exploit these differences, avoiding tax obligations and accountability in their home countries. Exploiting tax loopholes. 1. Incorporating in tax havens. Companies set up subsidiaries or legal entities in jurisdictions with low or no corporate taxes, even if they do minimal or no actual business there. The Caribbean is home to several tax havens which attract multinational corporations and the ultra-wealthy. Number 2. Using offshore trusts and accounts. Wealthy individuals may hide or protect their assets in offshore trusts or bank accounts. These structures obscure ownership and reduce tax liability by shielding income from taxation in their home country. Example, an individual in Trinidad and Tobago may create a trust in the Bahamas where no taxes on trust income are levied. Income earned through the trust is not declared in Trinidad and Tobago, avoiding taxes that would otherwise apply. Number 3. Transfer pricing. Multinational companies manipulate the prices of goods and services traded between subsidiaries to shift profits to low-tax jurisdictions. Example, a Barbados-based company with operations in Antigua could underprice raw materials sold to its Antiguan subsidiary. This minimizes taxable profits in Antigua and ensures higher profits in Barbados, where the tax incentives under the International Business Companies (IBC) Act provide lower rates. Number 4. Using double taxation agreements, DTAs. Some companies exploit DTAs between Caribbean nations and other countries to avoid taxation altogether. DTAs are meant to prevent the same income from being taxed twice, but they can be abused to create stateless income. Example, a company based in St. Lucia might route its income through a holding company in the Netherlands, exploiting the DTA to pay little or no taxes in either jurisdiction. Number 5. Engaging in citizenship by investment, CBI, programs. High net worth individuals purchase citizenships in Caribbean countries with low or no income tax through CBI programs. These individuals may then declare tax residency in that country while continuing to live and earn income elsewhere. Example, a wealthy individual from Haiti might acquire citizenship in Dominica under its CBI program. They then claim to be tax resident in Dominica, avoiding higher taxes in Haiti or other jurisdictions. Barbados has historically attracted companies through its IBC regime, which offered reduced tax rates for international businesses. Canadian businesses have frequently incorporated in Barbados to take advantage of its favorable tax treaty with Canada, allowing them to repatriate profits at reduced rates. British Virgin Islands, BVI. The BVI is a preferred location for shell companies. Over 400,000 businesses are registered in the BVI, despite its small population, because of the absence of corporate taxes. Example, a Jamaican businessman might register a shell company in the BVI to hold assets, avoiding Jamaican taxes on capital gains or dividends. St. Kitts and Nevis. Through its Citizenship by Investment program, St. Kitts and Nevis has attracted wealthy individuals seeking tax benefits. The country imposes no personal income tax, making it attractive for tax minimization. Example, a Trinidadian industrialist might obtain St. Kitts citizenship to claim residency there and avoid Trinidad and Tobago's higher income tax rates. 6. Trinidad and Tobago. Trinidad's relatively higher tax rates make it a target for profit shifting. Companies may use transfer pricing to shift profits to Barbados or other low-tax jurisdictions. Implications for the region. 1. Loss of revenue. Governments lose millions of dollars in potential revenue when individuals and corporations exploit loopholes. This affects funding for essential services like healthcare, education, and infrastructure. 2. Economic inequality. Wealthy individuals and corporations benefit disproportionately, while middle and lower-income citizens bear the brunt of taxation. While exploiting tax loopholes is often legal, it raises ethical questions about fairness and equity. Caribbean governments must strike a balance between attracting foreign investment and ensuring that tax systems are robust enough to prevent abuse. At the same time, greater regional cooperation is essential to close loopholes that allow profits and wealth to evade taxation, ensuring sustainable development for all.